Hello, everyone. Thanks a lot to all of you for joining online our session today, which will cover topics around data transparency, emerging markets, financial inclusion, and fintechs. So we are very happy to be able to participate in Financial Inclusion Week this year and are grateful for the opportunity to be able to showcase the results of the research that we've been conducting over the past summer months. My name is Ramkumar Narayanan, and I'm heading the market intelligence and investment solution lines at Tameo. And today, I'm happy to run you through one of our core flagship product on the research side, which is an industry survey that we produce annually about the state of impact funds investing into emerging and frontier markets. So we are together for the next hour or so, and I'll just give you a brief outline of the program. So I'm going to start by doing a small presentation on the key takeaways of our industry study. And then I'll be joined by Sofia Sunderji, who is the Research Associate Director at the Global Impact Investing Network, the GIN. And so Sofia and I will have a chat about, the takeaways of the study, the state of the market, and also with a deep dive into more financial inclusion strategies and fintechs. During the chat, we'll be happy to also highlight two fund managers who have a really tremendous experience into investing in financial inclusion and having fintech strategies, and that is Triodos Investment Management, who is based out of the Netherlands, and BIM, who is based out of Bolivia. So they will share, how they are positioning themselves, what they see in the market, and their track record. So I think we can get started. I'll share my screen with the presentation, and we'll get going. So I hope this works. So I'll give you a brief overview about Tameo. So for those of you who don't know the company, we are a relatively young firm that was incorporated in December 2020. So we are a Swiss-based impact investing specialist that guides fund managers and investors throughout their impact investing journey. And we do that by providing them with independent support services around research, impact management, investment solutions, as well as fund solutions. So here I'm not going to cover all the services, of course. I'm just going to focus on market intelligence because this is the topic of today. And what we've been doing on the side of running these industry studies about impact funds is basically to get data on the market, promote data transparency and accountability for the industry to be able to make evidence-based decision making. So part of the work is, of course, the study I'm going to present today, but also we are putting out there, in fact, making available all the benchmarks, the data and the market intelligence that we've been building at Tameo for the past 3 years. And one of the products is called Tameo Analytics, which you can see here. The website is down. You can have a look. The product is in its beta phase, and it's basically provide you access to information about the specific niche market that I'm going to present today. So I invite you to have a look, and we'll have more information at the end of the presentation as well. So let me start by giving you a bit of background on the study. So the Private Asset Impact Fund Report 2022 basically informs on impact investing strategies through funds that focus on developing countries. And they focus on either private debt or private asset or a mix of both strategies. So you can see that this specific niche of analysis is a subpart of the broader impact investing strategy, and that's what makes this type of industry study a bit different from other initiatives that exist in the market. So this is a study that's in its 3rd edition, and this year we've developed special topics of focus about fintechs that I'm going to present also here today, but also gender lens investments. A few words on the sponsors of this study, without whom, of course, these types of initiative can't exist. So big thanks to our lead sponsors, Center for Financial Inclusion, the Luxembourg government, as well as Symbiotics, but also all our 10 co-sponsors that you can see at the bottom here, really bringing all types of diversity and expertise in the impact investing space. So big thanks to all of them. So let me start by giving you the context of what we are going to talk about, what is the market that we look at. So here you can see a bit of, a breakdown of the global assets under management within the whole financial markets, 112 trillion, and then you have sustainable finance strategies, which form approximately a third of that. And then within sustainable finance, you have impact investing, of course. And impact investing today is sized at 1.16 trillion US dollars. And this is really a very recent market estimate from the Global Impact Investing Network. So they released their new market sizing exercise last week during their investor forum in the Netherlands. And I'm sure Sophia will be happy to tell you a bit more about their findings and this initiative. So for Tameo, we base our start with this 1.16 trillion, and as I mentioned, we look at a subset of this global impact investing market. And our subset really filters out all the investments that go through developed countries. We also filter out all the investments that go through listed strategies. So we only focus on private markets, emerging and frontier markets. And then within that, we only look at flows through specialized fund management companies. And that's our universe of focus at Tameo. That's the universe of focus of the study. And this market today, we estimate it at a cumulative size of $77 billion. So this universe within being a subset, it's of course very diverse in itself. You can see here the number of funds that are currently investing. So 671, that's a huge number of funds that we've identified. Cumulatively, they size at 77 billion, as I mentioned, and you can see here the breakdown by sector, prime sector of focus. And you can see, for example, that multi-sector funds are 205 in numbers and cumulatively $26 billion. So multi-sector funds are funds that don't have necessarily one impact thematic of focus, but rather diversify their investments into various thematics. Those dominate the market. Those are followed by microfinance funds at 123 number and 20 billion US dollars in size. And then you have SME development, climate and energy, approximately 115 funds. And then the rest, food and agriculture, health and education, housing, water and communities. So this market, again, it's very, very diverse. As you can see, it's run by 345 investment management companies. And 25% we estimate of the total size is managed out of firms based in the United States, followed by Switzerland at 15% and the Netherlands at 10%. So it's a relatively concentrated market around its top countries of investment management. So what we do at Tameo, once we identify our universe, so these 671 funds, these 345 managers, when we conduct the survey, when we launched the initiative back in the month of May, we contact all these companies. So we contact all 345 investment management firms and we request them to participate in our survey and provide us with quantitative, qualitative data on both business operations, on the financials, but also on the impact practices, both at their company level and at the fund level. And of course, once we do that, it's a sampling exercise. Not all the companies, not all the funds participate in our study, but we still managed this year for the 2022 edition to have a record participation rate. So we are very happy with the outcome. We managed to gather data from 198. So you can see here in the table on the right, 198 funds, again, broken down by sector of investment, and asset strategy. And you can see that the sample is tilted more towards fixed income strategies, followed by equity funds and then mixed funds. And it's also sector-wise tilted towards microfinance with 93 out of 198 funds composing the sample. So nearly 40% of the market and 90% coverage of the microfinance fund industry. So the financial inclusion space is very well covered by the Tameo study. So, and we are very happy to be able to disclose more information on that during this session. And I would like to point out to the very last line at the bottom where you can see that out of this nearly 200 fund sample, 86 of them have told us that they have fintech or embedded finance strategies within their portfolio allocation. So this is a thematic that we're going to go deep down with Sophia in the discussion. So just a few words now by looking at the results. The results showcase data at the end of 2021. And what we can see is that 2021 was a year of positive growth, back to pre-pandemic, levels, 17% growth across the sample. More growth, of course, on the equity side. This is also a bit driven by, you'll see later, lower AUM size as a base. So, a slight increase can really trigger huge numbers, but overall, double-digit growth, nearly 20% for the market. And it's in fact higher than what was expected last year. Fund managers told us 12% expected last year, and now they've managed to do 17% in 2021. Looking forward for end of 2022, as we are approaching end of the year, the forecast growth-wise in terms of assets is 6% for all funds. So here, a quick overview on the average fund size in our sample. So you have all funds on the left, and then you have the analysis broken down by sector, and then on the right, broken down by asset strategy. So here you can see approximately a fund in our sample sizes at 153 million US dollars in size, and you have varieties across sectors. Microfinance funds are the largest, fixed income funds as well, and private equity funds are the smallest, 81 million in size, and that's really linked to their business model, very highly focused in their portfolio companies and needing a bit less of diversification for their investors. So that really completely makes sense. How are these types of funds financed from investor-wise, so their capital structure? So 64% today of the capital is sourced from institutional investors. So they really form the basis of the funding for these funds. This is followed by retail and high net worth individual at 22% and 15% from public funders like DFIs. And you can see here there's really contrasting results when you when you segment the analysis by either sector or asset strategy. So for example, climate and energy focus funds really source their capital from DFIs. That's the same for education and health fund. Whereas SME development follows a bit, the 60-40% between private and retail investors. Now, looking at the portfolio allocation of this fund, so more on the asset side, we break down the portfolio in terms of sector of investments, and you can see that historically, since 2019, the portion of investments into microfinance has been decreasing to make room for other types of, thematics entering these portfolios. So you still have 50%, at least in our sample, of funds invested into microfinance. Then followed by the next nexus, SME development at 24%. And then you have food and agriculture at 8%, renewable energy and climate together at nearly 10%. Here, a view on the regions, so geographical breakdown of where this portfolio is invested at the end of 2021. So for the whole sample, you have two regions that compose more than 50% of the portfolio. That is Eastern Europe, Central Asia, as well as Latin America and the Caribbean. This is really driven by what we observe in the microfinance space, both regions being very strong markets for fund managers to invest in. But again, you have really interesting contrast if you segment the analysis by sector, asset strategy. So for instance, you have more of Sub-Saharan Africa when you look at education funds. You have more of South Asia when you look at equity funds. So those are the interesting, takeaways that we find with the granular information we are able to collect. A word on the type of portfolio company, so the investee type. Most of the portfolio is allocated through financial institutions. So when you have, an impact rationale, you want to, financial renewable energy, even in that segment, maybe a lot of the money still flows to financial institutions in order to finance, their renewable energy portfolios for the end beneficiaries. So the strategy today across the board is still 82% into financial institutions. And then we look at what flows through non-financial SMEs. So some funds do direct investments into those like non-financial companies, also larger corporations as well, and project finance is very less attended. Just a preview of what's about to come. So here we also started collecting this year data on fintechs and embedded finance companies as investee types. So they are not for us into the financial institution. They are really a bit different. So we are started collecting data, and you can see that the allocation is still very low, and I'll tell a bit more later during the discussion with Sofia. Bit on the net returns. So returns rebounded, similar to growth. So 2021 was a good year. In the report, we segment the analysis between unleveraged funds and leveraged funds. So the leveraged funds are those that finance their capital through borrowings. And for that, they provide a coupon return for investors. So that's the bottom of the table. So 3.5% in dollars. But then if you look at unleveraged funds, who are the majority of the sample, you can see that for debt funds, returns in dollars were 2.4%. and 2.1% in euro and nearly 2% in Swiss franc. And this is really up to what we used to observe in 2020, which was a really challenging year. In terms of outlook, and I think I'll stop there after to be able to discuss a bit more with Sofia. So the outlook, the market sentiment is very positive for 2022 in terms of financial performance. And you have most of the funds who are expecting either a slight increase, a moderate increase, or even a high increase in terms of performance when they arrive at the end of this current year. So let me stop here. I did 15 minutes. I think we can start having a chat, Sofia, about these results, what you see as well within your work with the GIN.
Wonderful. Well, thanks so much for having me here, and thank you, Ram, for the presentation. It's always fantastic to see just some of the data insights that are coming out on the impact investing industry, and certainly with this focus on impact funds in emerging markets, and of course with the focus on financial inclusion and fintech. As Ram mentioned, my name is Sophia Sunderji, and I sit on the research team at the Global Impact Investing Network, the GIN, where we manage all sorts of research related to the impact investing industry. We also run membership network activities, and we manage the generally accepted system for measuring, managing, and optimizing impact, IRIS+. And so maybe I'll go ahead and just dig right into some of the data findings that you presented, Ram. I mean, it was fantastic to see just how much market coverage this report reflects. $77 billion, I think you were saying, in private impact assets in emerging markets. And as Ram mentioned, this is a subset of the GIN's latest market sizing estimate, which sits at about 1.164 trillion US dollars across about 3,350 organizations. Which is significant and certainly reflects just the undeniable momentum that we're seeing across the industry. Of course, that figure represents not only fund managers, but also foundations, development finance institutions, banks, family offices, which very much reflects the diversity that we're seeing in the impact investing industry overall. But then, of course, we're seeing that diversity amongst the sectors of investments that Rum presented on as well, specifically in private funds in emerging markets. And of course, microfinance, from what we saw, is the largest. I think Rum had quoted about 90% of funds represented in the research are microfinance funds. And so unsurprisingly, it is the most mature sector. And so as a result, we see a lot of capital flowing towards it and a lot of data that's available, especially on the impact side, I think, which we'll get into later. But I also found it interesting, Rum, to hear about you speaking about the decrease in terms of portfolio outstanding amongst sectors in microfinance. We're definitely seeing the same thing here at the GIN. And what we're seeing is agriculture is probably the next largest sector in terms of overall impact assets under management. But I wonder if you can maybe shed some light on the diversity across funds in the sample. I know you've been doing the study for 3 years now. So how is the sample becoming more diverse? And can you share any examples that really highlight that diversity in the market?
Yeah, sure. So, when we started, implementing this specific study 3 years ago, we really built on, the idea was really to get more data on non-microfinance sectors, because we realized over the years, maybe 15 years ago, a lot of, the fund products available for investors in the market were pure microfinance funds. And it's true that now, there's an emergence. You've seen the number 671 funds today. And even in fact, most of them are multi-sector funds. So meaning that, these fund managers come up with, most probably based on investor demand to really diversify into different thematics. So multi-sector funds form like a third of the market, the overall market, as we see. So it's overtaken the microfinance funds dominance, and that's reflected, of course, in the allocation of the portfolio. That I've shown, where over 3 years the microfinance bulk goes from nearly 60%, I think, towards more 50%, and the rest is taken up by other thematics. I think that's true overall within fund structures and strategies, but also within microfinance funds themselves. We see that a lot of them are, going into SME financing, which is, also the next linkage towards financial inclusion. So not only looking at micro borrowers, but also looking to foster and maintain jobs for the bulk of the economies in these markets, which are SMEs. And SME development is really something that's growing. That's what we see. And food and agriculture, I completely agree, is something that's also in the radar for most fund managers. Within microfinance, there's also small pockets. They primarily invest into micro enterprises, but then there's a lot of of these funds who have done transactions into agriculture, renewable energy here and there, to really also test a bit the market and see. And that's how over the years we can see a huge diversification in the portfolio allocation.
That's really helpful, Rum. And I think we would be remiss not to speak about the investees themselves. I mean, the portfolio companies are just so critical to the impact that we are seeing in financial inclusion and really any impact theme. And what we're seeing in the data is that a lot of capital is still flowing through financial service providers. Is that the case, Rum? And any thoughts on the different types of investees that you're seeing, and then the implications for the actual impact goals that they target?
Yeah, a very good question. So indeed, what we see at Tameo, again, when we started this study, we wanted to explore, the flows to other thematics, and but the means of doing these other thematics today still goes through financial service providers. So the idea, if you do debt investment or equity investment in those companies, you really are looking to earmark, the green portfolio of these service providers to their end beneficiaries, or the education portfolio, or health services. So those are still the main way to have your impact within your sector of choice. Not completely the case. So 82% is still the bulk, but then you still have a lot of strategies that kind of go directly into the non-financial SMEs. So the risk is very different. The business model is very different. So you need, in terms of risk perception, doing directly non-financial SMEs is riskier than going through financial institutions, because in these markets, those types of FSPs are generally well regulated, and depending on the geographies, you have kind of a comfort level, especially if you're sitting, in highly developed economies in the US or in Europe, and then you have local teams there doing the due diligence, but then you still have kind of the regulatory bodies overseeing a bit, the financial health of the sector. So the FSPs are really the kind of the safest. But again, we are talking about, emerging frontier market, and still today it's a huge challenge for impact investing as an industry to really attract more capital, because if you look at developing countries, risk perception is still very high. And we really try through our work also to showcase that this type of asset class is growing, is financially sustainable, really highly impactful, and that's very important to get proper data about that.
And I think that very much relates to a couple of your earlier points as well around the data transparency and just being able to demonstrate what is feasible, especially in these markets, and especially given those perceptions around risk. It's also helpful to hear you reflect on that diversity at the fund level, at the investee level. And I realize that this is sort of where that subset of fintechs and embedded finance companies fall into your study in terms of types of portfolio companies. And I imagine that our audience is keen to know how different or similar is the fintech space from a fund's perspective, and maybe if you can share or explain a little bit that distinction between fintech and embedded finance institutions.
Yeah, sure. So maybe I can, do a deep dive, 5 minutes on the findings that we have. So what we did this year, we really had a specific side questionnaire where we asked fund managers whether they were having active strategies in terms of looking at fintechs and embedded finance companies. And only for those types of funds, we had a separate set of KPIs that we tried to track to try to understand, the number of transactions they've did, where are these fintechs located, what are the products that they have, and what is the impact, of course. So let me share again continue sharing my presentation, and I'll be happy to touch on the questions, Sophia, that you had. Just give me a minute. Yeah, here, go. Okay, so I'm going here, trying to always differentiate with what we see in the overall fund segment. So I'm putting back the graph about the investee type, as you mentioned, Sophia. And here really highlighting that still today within overall portfolios of these funds, fintechs and embedded finance companies are really tiny in terms of portfolio allocation. But again, you see some differences with equity funds, which really have today even 11%, which is not insignificant, I would say. And why equity funds? I think, the stage of business as well for these types of emerging innovative companies is, fed by private equity investors more than debt investors, if you look at the fixed income, which is very low. But yeah, you have interesting contrast here. Portfolio allocation is low, but what we see is that 86 funds in our sample have such investments. And here I've broken down the analysis by, again, fintechs, embedded finance companies. So the main difference is embedded finance companies are really positioned not in financial services at the core. So they do agriculture, renewable energy, but then these are companies that embed a financial component into their business model at a later stage to be able to facilitate, access to the end beneficiaries. So those are really emerging strategies that we see fund managers really looking at. And it's a very fine line in terms of differentiating between fintechs and embedded finance companies. And I believe still today in the industry, there's not a clear, demarcation, but within our study, we really try to separate both types of strategies. So in the fintech space, overall, at least the funds who answer to this specific chapter, 281 transactions since over the life of these funds. It's 4 on average per fund, so it's not a lot of deals. It's 417 million portfolio outstanding. And then embedded finance companies, it's a bit smaller, 103 transactions, 2 transactions on average for these funds, and 252 million portfolio outstanding. Geographic exposure, again, this really is a big difference that we see compared to the overall geographic breakdown I presented before. So here you don't see any Eastern Europe, Central Asia focus, which in fact is the largest regional allocation of impact funds. So you can see that it's a really different type of business model, and where they are located is really key. So Latin America, Caribbean is a very strong market, 30% in terms of fintechs. Nearly 50% of companies are based in South Asia. And for embedded finance companies, even more. And there's a lot of African, 15% of flows goes through Africa-based embedded finance companies. And those are generally related to off-grid solar companies that we classify as embedded finance because they have, they have enabled mobile money transactions to finance the solar panels at home. So those are the types of emerging, innovative mechanisms that we see in the market. Business stage exposure as well. I wanted to point out that this is a relatively different when you look at specifically fintechs and embedded finance companies. For embedded finance companies, most of it, 80%, so on the right, goes to growth stage companies. They are in their growth stage. Whereas fintechs, there's much more early stage, 40%. Then it's a bit more, equilibrium between growth and mature. Sector exposure. So again, this is very different from what we see overall for the fund. So if you look only at fintech investments, most of it is positioned within financial inclusion, which is not a surprise at all because there's been studies that, especially also the work of the Center for Financial Inclusion, that looks at inclusive fintechs, and that's in fact very much aligned with what we see here, is that most of it goes to finance and facilitate financial inclusion into these markets. And the next one, SME development, again, kind of linked. That the definition could fall within financial inclusion is debatable, but again, most of it is for financial inclusion, of course, when you go to fintechs. Embedded finance companies, no financial inclusion. That's by definition because, as I mentioned, they're positioned into another sector and they embed a financial product within their main business model. So most of it is in food and agriculture. You have 14% in renewable energy efficiency. You have 10% in health and education, for instance. And those are things that, are much less attended when you look at the overall impact fund segment. And the final one on the product exposure, I think just interestingly, fintechs look more at providing credit for the end beneficiaries. And you have also distinguishing products when you look at embedded finance companies, with point of sale being at nearly 80%. So I'm done with, I hope, Sophia, this gave you a bit of view on how different these two spaces are when you compare it to the overall approach.
No, this is definitely a helpful illustration, Rum. And we've spoken, I think, a lot about those contextual variables. And so geography and sector, that gives us a helpful market overview. And from what you've shared, I think we're definitely seeing a greater focus on fintechs in emerging markets. And of course, with the goal of increasing financial inclusion, which certainly makes sense. But I'm also curious to understand the impact itself. And so what does it look like to build an impact-focused fintech portfolio? And then what does the impact look like, and how does it factor into an investment process? And so perhaps with that, we can shift over to our video from Tim Krines, fund manager at Triodos, to share some of his thoughts on their approach to fintech and how the impact results factor into their own work.
Just give me a second, sorry.
No worries.
This one.
We saw it there for a second.
Yeah, that was the second video. Okay, so I'm ready, I think. The technical issue, I think I'm
part of the virtual world.
Yes.
Appreciate that, Rum.
There you go.
Excellent.
My name is Tim Krines. I work with Triodos Investment Management, where I'm a fund manager of the Triodos Microfinance Fund and the Triodos Fair Share Fund, which are the financial inclusion funds that we manage here at Triodos. And today I'm going to tell you a little bit more about our fintech approach. What we did in mid-2010s is invest into fintech funds to get more knowledge and to learn from experiences from another asset manager. And that helped us to have access to a global portfolio and learn about the fintech those days. Fast forward to today, with this pandemic in mind, and times of social distancing in COVID times, microfinance institutions, the fintechs that actually had digital mobile money, were able to remain in contact with their end clients through apps, calling, etc. But also could continue with money flows, whereas for cash-based microfinance institutions, it was pretty difficult to remain in contact with clients, but also to continue cash flows and cash movements. And I think, well, that's the accelerator for fintech in the financial inclusion game. Here at Triodos, we don't look at fintech as one sector, because it's actually we broke it down in several subsectors, from online lending, for example, payment services. Those are services that are close at hand of what we do. At the other hand, for example, the cryptocurrencies, which are much further from what we want to do. So I think it's very important to understand what you're looking at and not just talk about fintech. And also not to approach it as a different sector to microfinance, because what we see these days is that traditional microfinance institutions themselves, they also are digitizing. And I think the difference between a new business model, a new startup, a fintech, and traditional microfinance institutions that have digitized is becoming more gray. And I think this is also how we should look at the entire sector. It's not so much an either or, but fintech is a technology that can be used for new business models, but also by traditional microfinance institutions. All in all, to improve the lives of the end borrowers and to have easy access to finance there. What we see is that actually a lot of indicators that we're using these days for microfinance are still used to assess fintechs, especially on the impact side. So looking at the impact indicators, we're using similar ones. So also the percentage of female clients that are reached, the percentage of rural borrowers that are reached. At the same time, adding a number of indicators there. So also in the traditional microfinance assessment, we looked at over-indebtedness. We do the same with fintechs. For example, in what way, how easy is it for clients in the end to get loan by loan from several parties? At the same time, new indicators focus much more on the use of data and data privacy. How is the data used? Is it only for internal purposes, or is the fintech using it for something else? And that should be a red flag to us. So at Triodos, we follow for fintechs a tech and touch approach, which means that tech is of benefit. We need to assess it. It has a lot of benefits to bring financial services closer to people. At the same time, and that's the touch, it's not so much if you really visit an entrepreneur, but do you understand the behavior behind the algorithm? Do you, if you have an online loan application, understand the customer behind it and what the main incentives are for that behavior? And I think that is the main part of the assessment that we do on digital models, is look at the tech elements versus the touch. Is that understanding of the customer there? If we look at the breakdown, so what we did is build up experience first with online lending. That's close to our heart. We did microfinance institutions, so online lending models. Secondly, moving to payment services. Well, a new recent addition to our portfolio 2-3 years back is Coinworks Indonesia, which basically is a crowdfunding platform. And this is what I like. It's a model that we know and at our side of the world, that we also see in emerging markets. It actually facilitates, enhances capital flows, local capital flows. So what Coinworks does is they provide loans to small, medium-sized enterprises, but they also put these companies on their platform, and high net worth individuals in Indonesia, they can invest in these companies as well, which is an accelerator of capital flows in Indonesia. I think what is really important in the sector is to together actually build on guidelines that we're having. At the one hand, a combination of what we already have and what we have from the traditional microfinance days. So look at, for example, the CP pathway, the client protection pathway. This is equally important to apply to fintech. So not only stick to microfinance institutions. I think we need to expand the usage of the CP pathway to, for example, fintechs. Because indeed, as mentioned, the delineation between fintechs and microfinance is actually blurry there. At the same time, we need to be aware of the specifics of the fintechs itself. So the use of technology, the use of data, and I think that's where the development of the responsible digital financial services guidelines really helps the sector and to bring that forward. The other element with a lot of fintechs is that we see a changing ecosystem around them. So on the one hand, they need to raise a lot of capital. There's also a lot of interest from, let's say, bigger players in the world that maybe are less mission aligned to many of the traditional microfinance investors that we have. I think it's in the one hand, it's good because it brings new capital to the fintechs that play a vital role there. At the same time, there's a mission drift risk. And what is vital for us to see is the right ecosystem around these founders that are, at the one hand, need capital for growth, more capital than we sometimes can provide. And also, it is important to bring capital to fintechs. At the same time, are there enough mission-aligned parties in their ecosystem to actually help these entrepreneurs to avoid the mission drift in their portfolio? This is the end of my presentation, and thank you.
Well, that was fantastic. And as we heard from Tim, they aren't looking at fintechs as distinct from microfinance, but very much seeing that those lines are starting to blur, which resonates, I think, with what we've heard from others that are investing in fintech with that ultimate aim of supporting underserved communities and increasing equitable access to finance. And so digitizing products and services in financial services is just so critical to reach more women and to those living in rural areas, as Tim referenced. I think the other component that Tim touched on was what's needed to move forward. And of course, those guidelines on responsible digital financial services is one big piece of it, and then applying client protection principles to fintechs. But I wonder, Rum, if you might want to share with us a little bit more broadly what fund managers expect in terms of their own growth trends, and then maybe more specifically as well, what shifts are asset managers starting to see, and are they planning to change strategies in terms of moving from fintech to embedded finance, vice versa? What are you seeing there?
Yeah, sure. So in terms of outlook, we try to assess a bit the pulse for the next 3 years. So we try to gather information on, how they foresee their deal flow, growing. So basically how many new transactions they are expecting to do both in fintechs and embedded finance companies. And what came out was that most of the respondents would fall either between 0 to 10% growth in transaction volumes in the next 3 years, or 10 to 20%. So we are still, within the same like growth patterns we used to see for microfinance back in the days 15 years ago. But we are not at the above 50% mark where people expect, at least for these funds, having like over, doubling their transaction size from today to 2025. So, but I think it's again, it's a market where you need to carefully select. There's the impact components. There's risk associated to that, especially when we see that the big transactions taking place in the market. And I'm sure Triodos and the video we're going to see later also kind of carefully pick the right types of portfolio companies.
No, I think that's just it. And that selection of companies is so key. And maybe with that, we can shift on over and hear from another investor voice. BIM Investments, I know, has a lot to say about just the opportunities in financial inclusion and embedded finance in particular. And so with that, hopefully we can hear from Fernando Sanchez, CEO at BIM Investments, who will share really his own view on the types of investments that they are making, what they're seeing in the market when really looking for fintech and embedded finance deals, and really what the opportunity set looks like.
Regarding the type of investments at BIM, we have to say that the impact investment approach is part of our DNA and strategy. Our investments are focused in two main aspects: financial inclusion and clean energy. Let me explain that one by one. First, financial inclusion through our flagship fund called LogFund Next. Then we had LogFund, MILAC, Prospero, and other funds. This flagship called LogFund Next is now focused on financing more than 100 microfinance institutions in 15 countries of Latin America and Caribbean, with three main components. First, the local currency funding via loans or credit lines, helping the microfinance institutions to reduce the FX risk. Second, the capital markets component by underwriting agreements and secondary market creation for fixed income instruments issued by the microfinance institutions in the local markets. And third, the digital transformation component in 3 phases. First phase, performing a diagnosis of digital transformation of the MFIs in the region. Second phase, supporting the implementation of digital solutions and tools to the MFIs. And third phase, seeking to fund what we call digital portfolios of the microfinance institutions. Today, we already disbursed more than the equivalent of $126 million in local currencies to more than 45 microfinance institutions in LogFund Next. We expect to disburse more than $450 million in the following 2 years. We also perform a diagnosis of MFI's digital transformation that can be reviewed in www.imfdigital.com. And we supported more than 25 microfinance institutions in developing and implementing digital solutions such as digital onboarding, RPAs, applications, enhancement of internal processes, and use of artificial intelligence, among other tools. All these explained aspects are thanks to important support from investors such as Norfund, IDB Lab, IDB Invest, CFM, Anoviam, FMO, BIO, DG, OEB, DFC, Google, FinDev, FundaPro, and other local and private investors. Well, financial inclusion is one of BIM's activities with more than $450 million disbursed to more than 70 microfinance institutions. And the other activity is focused on clean energy. BIM is part of the Pan American Group, which has more than 116 megawatts of clean energy developed in the past years. Therefore, as part of our synergies objectives, we were able to develop and launch Innovasol, a company that provides solar solutions to small and medium companies in Bolivia and shortly to Peru and Chile. Today, more than 40 companies are able to use solar energy thanks to Innovasol. The business model is simple and very well accepted in the market. We provide all technical support and financing to each client, including the pre-investment assessment, 100% investment, construction and installation, operations and maintenance of each of the plants. This product is a reality thanks to Fundación Solidez as investor, and soon 3 new investors will join to continue the growth and expansion of Innovasol. That's our activities. Then regarding the question of what we see in the market while looking fintech and other types of finance deals, regarding the fintech market, I believe that that's an interesting factor on the screen, but we have to amplify the concept. Digitization of final client was demonstrated as an important tool to reduce the financial inclusion gap. According to several studies in our region, millions of clients started to receive financial services thanks to the digital transformation of the microfinance institutions and other financial players. Of course, this process was accelerated due to the COVID-19 pandemic. In our region, the final clients are requesting more and more digital services, considering the potential to make their business more efficient. Therefore, the need of digital transformation is highly appreciated in the market. But we should not forget that the solutions, tools, and funding must be focused on the final client, on reducing the financial inclusion gap, and to increase the quality of the financial services to the population. In practice, it is not very clear for some players, considering there are many examples of fintechs and financial institutions that try to incorporate digital solutions without a clear strategy within their organizations. Regarding how easy or difficult it is to find quality opportunities, we developed a methodology to detect, assess, negotiate, and execute investment opportunities based on several variables. One of them is clearly related to the solid credit technology of the microfinance institutions that we are evaluating to invest. That's precisely the problem to be solved with the new financial services providers that are so far testing new technologies in the market. In general, they were able to consolidate their financial technology in time. Therefore, we don't have to avoid this sector. What we have to do is to support these investments by creating new vehicles and attracting supporters with a higher risk appetite. That's the way we think it should be approached. The trends of the fintech and other type of technologies in our region is very interesting. We have to be on board that trend. We have to somehow support and somehow try to guide this sector to reduce the financial inclusion gap in our region and worldwide. That's my opinion. Thank you very much.
Wonderful. Well, I found it really powerful, especially to hear what Fernando was emphasizing on the role of end clients in demanding more access to digital services and really the role that that end stakeholder voice plays in decisions about the business model and the products and the services that are offered by microfinance institutions and other players. It's more efficient, it's what customers need, and it just makes business sense, which I think leads us nicely into really that final piece on impact performance that Fernando touched on. You know, for a while now, the impact investing industry has been talking about standardization when it comes to measuring impact. And more what we're seeing is that need to focus on actually managing the impact performance and how investors can use impact in their decision-making, as we heard from Fernando. This is a question that often comes up from investors, and the reality is that investors have really been unable to compare their investments on the basis of impact up until recently. At the GIN, we recently piloted the industry's first impact performance benchmark focused on financial inclusion, which is a first of its kind tool to allow investors to look at investment level impact results and make those comparisons to peers and also to the Sustainable Development Goals. I'll share that this fits into the broader impact lab that the GIN will be running in collaboration with 3 of our strategic partners, Visa Foundation, Temasek, and EQT Foundation, really to continue to develop these impact performance benchmarks, impact intelligence, and other tools, complementing a lot of what we're seeing in the industry, what Tameo is building out, and what several others are as well. I don't know, Rum, if perhaps you want to share any final remarks on what we've heard from Fernando on sort of the impact performance more generally in the financial inclusion and fintech space.
Yeah, sure. Maybe just to bounce back on what you said on the impact management and measurement, I think, of course, this is what makes, you know, the strategy of doing impact investing key and a differentiating factor to other types of more mainstream strategies. And today, there are a lot of standards. There's a lot of, you know, compared to maybe 20 years ago, there's a lot of upcoming initiatives. There's a lot of hard work, but still today, I think the investor community is looking to, you know, understand a bit better, trying to be able to compare. It's not always easy because as we see, the business models are different. It's very challenging to standardize, and I think it's great what the GIN has been, you know, trying to put forward with these benchmarks on the impact side. So for us, I mean, are totally relatable to what your work about this, and I think the fund management universe that we look at have, you know, also very sound impact management and measurement processes internally. They are really committed and the intentionality is there. I think they have in place across the value chain ways to make sure that risk mitigation is risk is mitigated in terms of negative impact and trying to really monitor the portfolio across the life of the investment. And we are trying with the study, I couldn't present here today, but we do have a lot of also standardized impact metrics, but at the fund level, not at the transactional level. And I think going sector by sector is the way to do it. And it's great that you're building this tool, Sophia.
No, that's helpful to hear, especially the piece about intentionality, which I know comes up often when thinking about how to measure and manage the impact of these types of investments. And the other piece that comes up often is additionality and how that's considered, investor contribution, all of which I think are ripe topics to continue the conversation. And so we certainly invite folks on the line and in the audience to continue the conversation with any of us afterwards. I am mindful of time, and I think we are just about at the end of it for today. So I'll share just a really big thank you to everyone for joining us. We're really grateful, and we would love to continue this conversation. The other thing I'll say, of course, is that the data shared today is part of Tameo's report that's coming out very soon. And so if you'd like to receive it, Rum, I don't know if you want to put up the QR code that folks can scan. And if you scan that, you can share your email address and you'll receive the report in your inbox. And so certainly feel free to do that. And thank you all so much again for joining.
Thanks, Sophia. Thanks, everyone. So happy to send you the report once it's out. Have a good day, all.